You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The futures markets can be downright scary. Limit up, limit down. What the heck is RBOB anyway? Are they going to dump a truckload of soybeans on your front lawn if you click the wrong button? Come to think of it, maybe you should just stick to your comfort zone. Or you can break out of it with the Futures Rundown. The Futures Rundown is here to help you make sense of these scary markets. We'll analyze all the top futures trading activity, explore the ins and outs of your favorite products, explain exactly how futures work, and hear from leading experts in the futures markets. We'll even tackle all of your wildest futures trading questions. If it involves futures, then you'll hear about it on the Futures Rundown. The Futures Rundown is brought to you by T4 Futures and Options. Elevate your trading experience with the T4 Futures and Options trading platform. Whether you prefer desktop or mobile applications, T4 delivers low latency and professional grade functionality for both traders and brokers. Take advantage of theoretical sheets, strategy solver, MBO, advanced charts, and a suite of powerful features to enhance your trading strategy. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. And now, it's time to break into the futures markets. It's time for the Futures Rundown.
All right, everybody, welcome back to the Futures Rundown, everyone's favorite new addition to the network. Glad to see so many folks are enjoying it. It really does make us happy. We go to a lot of effort to launch these new shows for you, and when folks respond so overwhelmingly, it just warms the old cockles of the heart. My name, of course, Mark Longo from the ever-expanding network that so many of you folks are enjoying. Remind you of a couple of things at the top of the show. First off, if you like what you hear here, make sure you're throwing a like, a star, a comment. It does help new people continue to discover the show, and they're all new on this show because it's a brand new show, so these early new reviews really do help people discover the content, so we appreciate it. And then B, of course, if you want to go above and beyond, want to discover some additional content beyond the on-demand side, you want to get 2 additional shows, an entirely exclusive podcast feed just for you, theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us on the old program today, I'm pleased to welcome back our old pal, futures author extraordinaire, none other than Miss Carley Garner. Carley, welcome back to the Futures Rundown 2 weeks in a row. Amazing.
Hi, Mark. Thank you for having me.
You like that, author extraordinaire?
I love that. I'm going to put that on my business card.
You should. Author extraordinaire. All right, Carley, this is your last chance to back out. I will say we've had a great array of guests on this show over the last 2 months. Very knowledgeable folks on a wide array of subjects. When I mentioned, we got this question about a month ago. I think you were on the show with me when we got it. And I've mentioned it to a few of our guests in the interim, quite a few of them actually. I said, hey, we have some questions about SOFR. We're thinking about doing a deep dive into SOFR. What do you think? You want to join us? And the answer invariably, Carley, was, I think I'm busy that day. Oh, yeah, man, I think I'm good. So SOFR just seems to be one of those products. It is impenetrable or off-putting or maybe both, even to a lot of people who live and die in the futures world, even people who trade a lot of rates. SOFR is just a beast unto itself. So what I'm saying, Carley, is, I'm legally obligated. I have to be here. You don't have to. So are you sure you want to go through with this?
think I've changed my mind.
Okay,
think
I
I'll-
understand. I'll
tap out.
Tap out. It's too late, though. I've shut the door behind you, Carley, because it is time for the contract specs.
Have you ever looked at a futures product and said, "What the heck is that?" Let's find out together. It's time to get the contract specs.
All right, listeners. As I mentioned, strap in. Our holiday extravaganza going deep into the product that mystifies and terrifies everyone, apparently. Yes, it is SOFR, 3-month SOFR. You know, just strap in, listeners. It's going to be some alphabet and some acronym soup in this one, so just get ready for it. If you're wondering why are we going deep into SOFR, a lot of folks have been asking, including most recently, one of our pro members, Chris Lovell, wrote this in. He says, hi. He was in town, apparently. He said, I wore my Red Options Insider shirt he won in a pro trading crate on LaSalle Street recently. Yeah, just side note, listeners, you want to get in the pro, you want to get a chance to win those pro trading crates. They are pretty cool. Then you too can wear your gear all up and down LaSalle Street, just like Chris did. He said, I was looking for your studio to take a picture in front of it, but he did find some others, including Bar Chart and Citadel in the area. Yeah, there's no big sign. We try to keep it low key, but we are right across from the former Boeing headquarters. Boeing is still on the building, so you can find us there. He writes, as for the Futures Rundown, he loves the new show. He's morphed into a futures options trader. Well, there you go. So I would love hearing about the nuances of the underlying futures. Would you please do a deep dive into all things SOFR? Molto grazie, Chris. Well, we can do that for you, Chris, just because you asked so nicely. Let me kick it off with a little bit of a history lesson, Carley. Then I want to get your thoughts on kind of what you're seeing right now in terms of the use case, how many of your clients are really beating down the door with questions about SOFR. But our listeners clearly are, which again shows you just the evolution of this audience, listeners. There are not a lot of pros who want to go deep into all things SOFR. You folks stand out amongst the multitudes out here. So if you're saying to yourself, I don't really know what that is, 3-month SOFR, you're probably familiar with the previous incarnation or iteration of this product, which was Eurodollars. Everyone's kind of familiar with that concept. It's just a dollar deposit held in Europe, pretty much, and the interest you're getting on that. That's pretty much the root of all of this stuff. But you're saying that's not what we're talking about. No, we're not talking about that, because the Eurodollar was effectively phased out in favor of this new product called SOFR, SOFR, which stands for the Secured Overnight Financing Rate. It effectively measures the cost to borrow US dollars overnight using treasury securities as a collateral. Now, a lot of reasons that were behind the shift away from the Eurodollars. You probably have heard in the early 2000s into the mid 2000s about the LIBOR scandal. If you hadn't heard about that, just type that into your Google machine. You can read all about it. There were a legion of lawsuits that were settled over whether LIBOR, which was, of course, the London Interbank Offered Rate, which was pricing a lot of these Eurodollars deposits and the options and futures as a result, whether it was being manipulated. And so as a result, people started to look askance on LIBOR and the products associated with it back in 2014. So we're going back a decade now. Back in 2014, the Fed created a committee called the Alternative Reference Rates Committee, aka the ARRC. Again, alphabet soup coming at you. This is your fair warning. There was their job to identify an alternative to LIBOR. And as they say, after extensive research, they came up with the Secured Overnight Financing Rate in June of 2017. That was what they chose as their preferred alternative for the U.S. marketplace to LIBOR. As a result, 3-month SOFR products were launched back in 2018. They replaced LIBOR, and they started phasing them out over time. LIBOR or Eurodollars really were officially phased out as of June 30th of last year, which is why if you go over there now, there's some vestigial positions, but there's no new positions out there in Eurodollars. All right, so that's our history lesson. Carley, you have anything to add to that in terms of the origins of SOFR? And then B, I'm curious for you, you're dealing with a lot of clients over there day in, day out. How hot is SOFR with your clients? I guess the thing I'm asking is, why did you agree to come on this show, Carl?
Well, there's a couple things to mention here. So SOFR futures, as you mentioned, replace Eurodollars because of basically the removal of LIBOR rate as the risk-free rate that banks use to loan money. The true purpose or the true use of SR3 or SOFR futures is to hedge interest rates. So to be honest, we don't have a lot of clients that trade them that often. You'll notice it's the most liquid contract in the world. There's 5 to 8 million, maybe 5 to 6 million contracts traded a day. So obviously people are trading it, but if you look at the nitty gritty, it's usually really large institutions hedging their interest rate price risk. Somebody like you and I, well, I don't know your financial situation, but I personally don't have, several hundred million or billions of dollars sitting in a money market fund or in T-bills or some sort of interest rate product that I need to hedge using this product. So for me, I think it's a really awesome speculative vehicle, and I encourage our clients to trade it because the margin is so low. It's less than $1,000. It's about $850 for the front month contract. Margins do go higher if you go to the back months, but somebody that's just getting started in trading can look at this product and actually get their feet wet without doing too much damage. They're not going to change their lifestyle and get rich overnight if they're on the right side of the trade, but they're not going to lose their shirt either. So it's a really great introductory product. And my favorite part about it is it allows people to participate in strategies that would maybe otherwise be too risky for their account. For example, you can go long or short futures, and you can hedge with long options with very, very, very little risk. Now, the odds of you hitting a home run and making a ton of money aren't great, but the ability to practice that kind of a strategy with such a low maximum risk is just an amazing opportunity. So I love SOFR futures, not because it's the most efficient way for most of us to hedge our interest rate price risk, but because it's a really great starter tool for those trying to get into futures trading.
I love how you call it a great starter product, because I think for most people, this is too intimidating to even break. Allow me to do, if you will, Carley, a dramatic reading from CME's own website. This is just one of their many little segments they have up there to try to explain what these products are and what you're trading out there. This is from the price quotation section of the contract specs. Just, you can see why so many people decided they were busy today, Carley, when you hear stuff like this. So this is what they thought would be penetrable for people out there. Allow me to put on my dramatic reading voice. Here we go. All right. Price quotation. Contract grade IMM index equals 100 minus R. R equals business day compounded secured overnight financing rate. Parentheses. SOFR. End parentheses. Per annum during contract reference quarter. Reference quarter. For a given contract, interval from, parentheses, and including, end parentheses, third Wednesday of third month, preceding delivery month, to, parentheses, and not including, end parentheses, of delivery month. Well, Carley, there you go. That says it all. Why could anyone have any questions? I don't understand.
Okay, I would see these people that write this stuff are a lot smarter than I am, and they have much more technical brains. I keep it very, very, very simple. The SOFR is basically, it's almost identical to the Fed funds futures. Most people are aware of what the Fed funds are because the Federal Reserve sets that overnight borrowing rate. The difference between the Fed funds and the SOFR is the SOFR is freely floating, whereas the Fed funds rate is set by the Fed. And also the Fed funds rate has no collateral, and SOFR is backed by T-bills. So to be 100% honest, it's kind of semantics. If we start picking, I mean, for our purposes, if you're hedging $1 billion portfolio, it's different. You probably need to know all those specifics. But for retail traders and speculators, like most of us are, we don't need to know that. All we need to know is basically we're trading a short-term interest rate. You can even think of it, this isn't a perfect relationship, but you can even think of it as like trading T-bills. Now, somebody that's really specific is going to argue with me on that, and they're right. But the reality is, for our purposes, I mean, we're talking like differences of tenths of an interest rate and on a futures contract, of half of a tick or a tick, which is $25. So it's really meaningless for our purposes. So the simplest way to think about it is you're basically trading T-bill interest rates. That's not 100% accurate, but it's accurate enough for our purposes. And so if you see the rate that you see on the SR3, if it's at, let's say, like 95.52.5, to get the yield that is inferring, you take 100 minus 95.52.5, or let's just round it to 95.50. If it's at 95.50, then that's a yield of 4.5%. That's by taking 100 minus 95.50, 4.5%. So it's priced like a discount bond. And to figure out how much you're making or losing, it's at $25 per tick. You're not going to see these things move very quickly throughout the day. Most of the time, you're going to see one tick at the most, maybe two. On a really busy day, you might see 2 or 3 points, but it's a very slow mover. It's like watching paint dry, which is, again, why it's really great for beginning traders. So don't be intimidated by all the crazy equations. You really don't even need to know that much detail.
Yeah, you gotta love when they throw the equations into these specs.
Those are a red flag.
That's just scaring people off. So yeah, Carley's right. There are simpler ways to look at it. If you do like to go a little bit deeper, let's just do it really quickly for you. What are they even talking about in some of that jargon and equations and throwing variables at you? You heard that equation, IMN index. What the hell is that? That is the International Money Market Index out there. So that's what they're calculating this value off. Again, you're going to hear a lot of alphabet soup in this one, listener, so just strap in. Also, you should refresh yourself if you're not familiar with kind of the nuances of a lot of rates products. They're mostly quoted in basis points. Remember, a basis point is 0.01%, so you're going to hear a lot about that, and also the basis point value of some of these contracts out here. But that money market rate international money market rate is pretty easy to calculate, actually. They kind of give you, it sounds crazy the way they write it here, but it really is just 100 minus effectively whatever SOFR is trading at. And let's say SOFR is hanging out at exactly 4% right now. So you want to calculate that IMN index. It's 100 minus R, which is the SOFR rate. Again, it's obtuse nomenclature, but that's what they're throwing at you here. So in that case, it would be 4% from 100. So 96 would be your IMM. And that's what you're pricing your SOFR contracts on out there. Now, I mentioned basis points. You're going to be concerned about basis point values with these contracts. So you're going to see BPV thrown around a lot. That is your basis point value. You're also going to see another acronym, DV01. Again, they're just really trying to confuse you, listeners. That is the dollar value of 1 basis point for a move in the yield out here. So a 1 basis point move in the 3-month SOFR contract typically equates to $25. So just bear that in mind. So we were just talking about before, we were calculating these rates out here using that index. So let's say we were at 4%, like we just calculated it before. By the way, these move inversely to yield. SOFR moves inversely to yield. So bear that in mind. So let's say in our example, SOFR is hanging out at 4%, and then it moved up to 4.1%. In our example, what happens to your position right there? So you have just a straight up SOFR position out here. It moves 0.1%. So it's going to decrease by $250. Remember, you moved 0.1%, aka 10 basis points. Each 10 basis point, $250. So you're moving $250 in the value of that position. Carley, anything to add there in terms of the basis point value, all the madness they might be confused about, like the IMN index and all that fun?
One other, if anyone that's ever read any type of finance book or went to college for finance related fields, they've probably heard of, I'm sure they've heard of the risk-free rate. The SOFR is basically the risk-free rate. So if somebody goes into a bank and borrows money, in order for the bank to make money, they know they have to charge something above and beyond the risk-free rate. So that's really what this product is all about, allowing big institutions and banks to hedge their business operations based on the risk-free rate. So that might be another way to think about it. You would also, once again, I'm going to just throw this out there. I know it's not absolutely correct, but the T-bills, treasury bills, are generally referred to as the risk-free rate as well. So you're not going to see any really big discrepancies between Fed funds rate, SR3, and T-bills. They're all roughly the same thing, just different products. SR3 is the most liquid product to speculate on that type of interest rate. So that's the one to go to. But I wouldn't get caught up in the details because from a monetary standpoint, those types of things aren't going to change your P&L much. I mean, maybe $6.25 or something crazy like that, but it's not meaningful. So don't get bogged down on the details and the confusing things. My suggestion is keep it very simple and just understand that you're trading the par value. Par value of any type of discount bond is 100. So it's the par value minus the current interest rate. That's the value of the bond, and keep it simple. That's my mantra.
I usually agree with the KISS, the keep it simple, stupid out there. And I agree with you on this, except for right now, Carley, where we're going to go a little deeper in the moment just to kind of dispel something. Because you mentioned something else I can't ignore, the 6.2. I love the fact that we're talking teenies and eighths again, just as an aside, Carley. That brings me back to my old market making days when everything was quoted in 16ths and eighths. And your value as a market maker was determined by how quickly you could do those fractions in your head, Carley. At the end of the day, it was very important high-level basic math that determined a lot of what we did out there in products like the SPX. But you mentioned some of those ticks. Let me just hit those quickly because, Carley, I think they decided this product was too straightforward. It was too easy to understand. So they had to mess with the ticks even more. So you mentioned the 16th, but actually the typical minimum tick for these contracts is going to be 1/2 of a basis point. There you go, listeners. Which turns out, remember, a basis point is $25. So 1/2 of that's going to be 1/8 of a dollar or $12.50. Yes, 1/8, 0.125, one of the old fractions and decimals I did a lot with back in the day. But you know what? That's too straightforward. They can't keep things standard throughout the life of a contract. No. So as we approach expiration with the 3-month SOFR contract, listeners, that minimum tick size is going to change once you get within the 4-month window heading into expiration. Guess what? That minimum tick gets cut in half again to what Carley was just talking about, the 0.0625, aka 1/16th for the last 4 months of expiration. So Carley, I'm going to put you on the spot. Riddle us that. Why that extra level of obfuscation just for our listeners, Carley? Why?
Well, I wish I had a good answer for you. If you think this is fun, wait till you start looking at what they've done to treasury bonds and treasury options, which are quoted in different sizes of fractions.
Yeah, the units out here are kind of fun. We may have to do a second episode down the road, Carley. This might be part 1 of all things SOFR, because there's a lot to come to grips with, including this, Carley. We've gotten this far into the episode. We haven't even really touched on this. We keep saying 3-month SOFR, 3-month SOFR. Why are we saying that? Why is it 3 months? Why isn't it just a 1-month SOFR contract, Carley?
There actually is a 1-month SOFR contract. It's less liquid, but it does exist. So if for whatever reason you need to hedge your personal T-bill holdings for the next 30 days, that's the one to use.
But the 3-month SOFR typically lines up with the more traditional use case, correct?
Correct. Yes. 3-month is honestly, it's better for hedgers and speculators. Thus, it has a lot more trading volume.
So yes, Carley is correct. There is indeed a 1-month contract, not quite as liquid as the big dog, the 3-month SOFR. And talking about liquid, this product is a beast. I mean, it really does. We joke about how obtuse it is. And for the lion's share of you out there, it probably is. But that doesn't stop it from putting up numbers, ridiculous numbers, millions upon millions of contracts every week out there in the futures and in the options. So 3-month SOFR, very much a beast out there. Obviously, a lot of that is big institutional paper trying to hedge and speculate around these very minute fluctuations in rates. So it's going to drive a lot of flow at the end of the day. And a lot of that use case, again, lines up to what we were saying earlier about that 3-month time span. Speaking of the traditional use case, if you go pull up a SOFR right now, SOFR options chain, looking, at the futures, you'll see what may also be surprising and or intimidating to you is an array of colors. So if it's not enough that they're throwing at you months and series going all the way out 10 years, yes, we're talking about, near-dated fluctuations in rates, and yet these contracts go out 10 years. So if that wasn't enough to really just throw you for a loop, listeners, they're also going to throw you an array of different colors. They do that to try to simplify some of these products and also bundle them together, put them effectively what they call packs out there, because people are going to use these usually as strips. Maybe they want to sell Again, going out 10 years, maybe they want to sell the first 4 quarterlies in the 3-month SOFR for the first year. So each one of those 4 against maybe a loan that they have maturing, and they want to sell each quarter against a different portion maybe of that loan. So they want to sell all of those together. So those are collectively called the whites out there. Then it changes every year. The 2 years are the reds, 3 years green, 4 years blue, 5 years gold, 6 years purple, 7 years orange, 8 years pink, 9 years is silver. You go all the way out 10 years, listeners, aka the 37th through the 40th quarterly expirations. Those are the copper. That's the copper pack. So that lines up with a lot of institutional use cases. Maybe they come in and they have some loans they're working with that all are in that 2-year time frame. So maybe they want to sell that red pack. Maybe they want to sell the gold pack going out 5 years. Maybe they want to do a little bit of trading. Maybe they want to do the golds against the reds. So this eases some of the institutional use case out there. It prevents them from having to, let's say, leg into 4 different quarterly options just to get a trade off. Obviously, if you know anything about legging trades, there's a lot of risk there. They don't want to take that. This eases the transition. This makes it all quotable in one easy to understand package. You can also spread them much easier. You're talking, instead of having to leg into 8 individual options, you can just do the different packs against each other. So it tends to ease the use case. Carley, any thoughts about the different colors out there and how they could sometimes look intimidating to newer SOFR traders?
Those colors are intimidating for me, and I've been doing this for over 2 decades. So again, I'll say I'm really glad that you brought this topic up so that when people run across it, they understand the concept of it. But I don't think for most speculators, I think this is, don't focus on these types of things. Focus a little more on the position at hand, what the margin is, what your trading strategy is, what's going to trigger your signals, that sort of thing. This type of stuff is very confusing, and it's going to cause people to. And again, I'm glad that you mentioned it. I'm not criticizing you at all. I'm just saying, we don't want to have some sort of paralysis or analysis paralysis going through people's head, because that's what these products do. They're very intimidating on the surface, but I think once you start trading them, you start to realize they're actually probably the simplest products to trade on the board.
I like it. The simplest products to trade on the board. As I thought, Carley, we're already out of time. So we are going to probably have to do down the road an episode 2, because A, we didn't get to everything. We didn't get to, let's say, mid-curve options or some of the other crazier stuff out there. I think the notion of just the different expirations, Carley, for a lot of people, trading a nearer dated option against a longer term future and vice versa, kind of blows their minds. There's a lot of playing with expirations here. In general, these are near dated rates we're talking about, yet we're going out 10 years. That also blows a lot of people's minds. The changing of ticks, all these things. So I think we need to do a follow-up down the road a little bit, maybe get into some more of these concepts in a little bit more detail. I'm sure our listeners are also going to have a ton of, they already do, just to kick off this episode. I'm sure they're going to have a ton of questions after listening to this. Why is that the case? Why is that the case? And so, again, I'm legally obligated to answer them, Carley. If you want to dodge it, I understand. But that said, I think there will have to be a SOFR. So let's call this one Everything You Always Want to Know About SOFR Part 1. More to come out here, listeners. But Carley, if folks in the meantime have a lot of questions, and they clearly do, about SOFR, you're saying it's one of the more, once you come to grips with it, it's one of the easier to understand products on the board. So if folks want to understand it, where should they go? What should they do?
It is. Visit us at decarleytrading.com, DECARLEY trading.com. We're also on the socials. You can check us at X, at Carley Garner is the handle.
That's at Carley Garner, listeners, GARNER, all one word over there on the old Twitter. She tweets out a lot of good stuff, so make sure you're following her over there. And while you're searching for things online, make sure you type T4 futures and options into Google. That'll get you to our friends over there at CTS Futures. You get a free month. Can't go wrong with that. Maybe you want to start nibbling. Maybe this episode emboldened you to want to dive deep and begin your own SOFR journey. Maybe you'd have said, you know what, this stuff is impenetrable, it's not for me. I get you either way. We're not going to judge here. on the show list. Trust me, I've talked to a lot of futures professionals who want nothing to do with this product, so you are not alone. But if you're one of the brave few, maybe you want to venture over there to T4 futures and options and give it a try for yourself. As Carley said, you can keep it simple. The relative hit to your P&L if things go against you is fairly modest, so it's not going to run you over at the end of the day. So if you can get past everything we just laid down there and a whole bunch more, then there certainly could be some appealing factors for you over there. Check them out for yourselves. T4 futures and options. Tell them we sent you. They'll be very happy to hear from you. And of course, that's going to do it for us on this extra special holiday palooza. So if you're sitting there, you're in a tryptophan coma, you're already a little groggy, then there you go. A full half hour of all things SOFR to really put you to sleep. But hey, you folks asked for it. Don't blame me. You folks wanted it. We deliver because we like you folks out there. I'm sure you're going to have more questions after listening to this, so send them in. We'll probably do a follow-up, go deeper, maybe get into some of the other elements of this product, maybe talk through a few more examples. Once you come to grips with it, as Carley said, it's not as intimidating as it seems, but the first blush, some of the explanatory materials, watch out for the stuff on CME's website, listeners, even a lot of their videos out there. Kind of impenetrable out there. So you're going to have to, that's why we tried to make it a little bit less intimidating for you on this show, but it's going to take some time to come to grips with this. Don't worry. That's what we're here for. We'll see you back here next week, another episode of the Futures Rundown. Stay safe out there, everybody.
Thank you for tuning in to the Futures Rundown, proudly sponsored by T4 Futures and Options. Experience the T4 Futures and Options trading platform with its seamless desktop and mobile applications, low latency, and professional functionality tailored for traders and brokers alike. Take advantage of T4 theoretical sheets, strategy solver, MBO, advanced charts, and much more. Empower your trading journey with T4 Futures and Options. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.